Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we break down the market action amid a muted response to the latest inflation print coming in cooler than expected. Plus, we'll break down what that cooler than expected print means for the future of the Federal Reserve. And we'll tap into the tech trade and where the Magnificent Seven is heading next after staging a big rebound to start the week. Half an hour into the start of U.S. trading, let's get you a check on the markets brought to you by Tasty Trade. Taking a look at the major averages here, you've still got the Dow under pressure due to some company-specific news with United Health, but your S&P 500 up about 0.5%. Your tech-heavy NASDAQ taking on the majority of the gains. It's up about 0.9%. Some company-specific news there as well, with NVIDIA up nearly 2.5%, perhaps boosting the broader NASDAQ. And the NASDAQ 100, by the way, completely retracing its losses year to date. It is now flat on the year. But let's flip it over to the bond market and take a look at yields continuing their climb to the upside. You've got your 10-year up about a basis point. Your 30-year yield is up about 3 basis points. Interesting to see what the growth picture is that the bond market is pricing in off the back of that cooler than expected inflation print. And lastly here, let's take a look at Bitcoin. One of our risk-on, risk-off indicators here. It does look like it is moving to the downside, but after a record-breaking run over the past couple of sessions here. Well, I want to bring in my guest host for the hour. I've got Lou Basenese. He is with Prairie Operating Co. as the EVP of Market Strategy. Lou, great to have you here.
Good to be here
this morning. Let's talk about the market action here because stocks are edging higher. It's not like a massive rally here. Do you think the market is pleased with this CPI reprint?
Yeah, I think it's a yawn, right? Like I think for the markets to really rally on the CPI print, we need to see a tremendous drop. And I think what's interesting is this is the first report where we should have seen some impact from tariffs. And I think that's just okay, there's not really that worry. We've seen this, we've been having this discussion. The soft data has been suggesting really terrible times ahead. But now we're getting actual hard data. It's not coming through. So I think market is just, okay, this is good. Let's see what happens next with the Fed, right? I think it gives a more clear picture for the Fed as opposed to them having to balance maybe labor changes, the jobs market changing quicker while we have a dreaded stagflation scenario where inflation might be returning. So
can the Fed and can we trust the data when it's being gathered as negotiations are getting struck as we speak? Yeah,
trust but verify. I think this is one data point. It's 1 month. I think it's going to take several months before any of those tariff impacts to work their way through the system. We saw it in the Q1 GDP print, right? A lot of inventory building. How long does it take to shed that off? How many companies are sitting back on capital expenditures? You just don't know those decisions that are being made in the C-suites and where it's going to trickle through into the hard data. So I think can't put it all on one data point. I wouldn't say that this is a given now that the Fed's going to cut next month. I haven't looked at the probabilities. It's swung so fast. I mean, a month ago there was only there was a 60% odds of a June rate cut. Now it's down to like 8%. So I think everyone's still trying to figure out what Jerome Powell is going to do, and Jerome Powell might still be figuring out what he's going to do.
Right. We're still looking at 2 rate cuts priced in from the market this year, but I do want to get to some of the individual names that you sent over to us. Taking a look at what's driving the major averages today, you've got tech as the biggest sector gainer. I know that you are only looking at one name in Magnificent Seven, though. Talk to me about that.
Yeah, it's Alphabet. I mean, I think I've used the analogy and it's getting worn out, but the Mag 7 is a boy band that broke up. Just everyone didn't get the memo yet. And so I really think you're seeing solo careers and outperformance. Apple, I think Alphabet is the next one to have a breakout solo career because if you look at the valuation, it's the cheapest it's been in over a year, and it's the cheapest of the Mag 7s, and it's really attractive from that standpoint. And if you look at the other side, well, can they compete in AI? Look at the last quarter's results. They're actually showing what matters in AI. Not just that we can do a lot of computing power, but that we can use that to help our customers do better advertising. So it's really driving their business. I think that's going to continue. And I think it's one of those things. It's fallen out of favor over regulatory concerns. They might break them up. I don't think that's ever going to be happening. We've been talking about this for 10 years, right? Breaking up big tech. Not a single big tech company has even been close to being dismantled. So I think this is an overreaction, and I think it's undervalued. I'd rather buy here cheap at a good price while they have good growth coming than trying to chase a name. I love Apple too. I've been a long-term shareholder, but I don't think it's really compelling at current prices.
How are you thinking about Apple right now in the face of tariff headwinds?
Yeah, look, Steve Jobs gets paid to do exactly what he's doing. He's showing that he can move production. I'm sorry, Steve Jobs.
No.
Yeah, Tim Cook. Tim Cook's doing what people didn't think he could in the
Right.
aftermath of Steve Jobs.
Right.
And if he just points to the scoreboard, if you look at the stock, it's up 1,300% since he
Right.
took over in 2011.
Right.
So I think he's showing, hey, I can be nimble even as a multi-trillion-dollar company and move production and save on costs. And honestly, a $900 million hit, not that big of a deal to Apple. It sounds in absolute terms like a big deal, but when you look at these companies that are making, $15 to $20 billion a quarter, $900 million is really a rounding error. And then if you give, Tim Cook some time to really figure out where he's going to get supplies from, I think in a quarter or two, it's long forgotten.
Yeah.
But middle of the year always seems to be the time everyone gets negative on Apple. The next iPhone's not going to be great. They need to innovate or they're going to die. It's the same mantra every time, and yet the company keeps executing and going higher.
Yeah, I keep hearing from sources that they're investing in management teams right now and not specific names, and that certainly makes the case for that when you talk about Apple and Tim Cook at the helm. Thank you so much for that insight, Lou. Appreciate it. You're going to have you for the rest of the hour here to give more unbeatable context. We're going to have all your markets action ahead for our audience, so stick around. You're watching Catalysts.
Weak buck, easy ride. 2025 is ripping up the old playbook as the U.S. dollar stopped dancing with the 10-year yield for a stretch during all the tariff turmoil. Now they're doing the tango once again. Let's dive into what this means for stocks and risk markets writ large. I'm Jared Blickery, host of Stocks in Translation. Well, let's start with a chart. This is a 4-year chart of the U.S. dollar index, that's in white, and the 10-year yield rate. And this is the U.S. borrowing rate going out 10 years. And you can see for the most part, they're going in the same direction most of the time. They diverge a little bit, but if you'll notice, they're going up here, they're going down here in tandem, up and down, and it proceeds until we had a little bit of a hiccup lately. So things are changing, and this is what I mean by the new playbook. So this zooms in a little bit on the last chart. This is a 1-year chart of the dollar versus the yield, and here you can clearly see this divergence. And when that happened, that was in early April, and it happened around Liberation Day. Suddenly, yields shot up and the dollar dropped. Why would that be? Because in the old days, a dropping dollar meant risk on. Well, not in this context. In fact, the S&P 500 had some of its worst days since the early pandemic. Meanwhile, yields were shooting higher, so they were going in an opposite direction. So let's break down what this correlation means. First of all, when I say the dollar yield correlation, I'm looking at a 1-year link between the US dollar index, and this is a ticker symbol right here that you can find on the Yahoo Finance website, and the 10-year Treasury yield. And that's a ticker right there, TNX. Now, if they're positive, that means that they're moving together. And if they're negative, that means they're moving apart. And the slope matters too. So an increasing slope, as we're seeing here in green, means that they're moving together in an increasing way. So this chart goes all the way back 4 years, and we do see a little bit of a decline here in the beginning of that 2022 bear market. But early on, even as the S&P 500 in white continued to move lower, the correlation had bottomed and it started heading higher. This proceeded right into early November of 2024 last year. And guess what happened right back then? That was the Trump election. From there, from that peak, it slowly declined, but then it started accelerating in January when we started hearing more rumblings about the tariff policy. Then it took a bigger dip, came up a little bit and really sunk as Liberation Day, and the whole world realized that they didn't want to own US dollar assets. In fact, kind of the mantra was anything but US dollar assets. So what does this mean going forward? Well, the last few days have actually seen a resumption in that positive correlation between the 10-year yield and the US dollar index. In fact, that happened right after the Fed meeting, and we saw it in force on Thursday. That would be last Thursday, a little bit Friday, but then Monday, yesterday was a huge day. Over the weekend, we got that big tariff detente with China, and that kind of signaled a more risk-on environment. And so we have seen the dollar moving higher, actually quite forcefully, along with U.S. yields. And far from being risk-off, the fact that they're marching together again and the dollar higher, that means that the whole world is accepting U.S. dollar once again. So going forward, we want to pay attention to this relationship, not just the direction of each of these assets individually. Tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared, thank you so much. It's now time for some of today's trending tickers. We are watching NVIDIA, Hertz, and On Holding. First up here, NVIDIA, with CEO Jensen Huang saying the company will send chips to Saudi Arabian AI company Humane. Humane, which is focused on data centers, AI infrastructure, and developing Arabic LLMs, is owned by the kingdom's $925 billion public investment fund and was unveiled on Monday here. The share's up over 4.5%, responsible for a lot of that lift in your NASDAQ this morning. Lou Basenese is still here with me. Lou, how are you thinking about NVIDIA? I know it wasn't on your buy list for the Mag 7, but where do you see the stock?
Yeah, so I am a shareholder. I got in late, though, so I didn't enjoy all the run. I think it's really critical. If you want to play AI, you have to own this blue chip, no pun intended, chip maker, because they are the majority of the chips sales. I think chips are the oxygen of the digital economy. We have to understand that for us to do $600 to $700 billion a year in annual sales in chips, they fuel everything. It's not just AI. I think that's what everyone overlooks, is the chip sector is much broader, much bigger. There's tailwinds here that are going to persist. NVIDIA alone, I mean, still trading about 21% off its all-time high, 52-week high. There's room for it to continue to run on good news like this, and obviously on good earnings, because they report off cycle. So we'll still get that look here before too long.
Right, exactly. That's going to be the key final earnings print of those big tech names to watch here. But let's look at Hertz, reporting a wider loss and lower revenue in the first quarter. The rental company attributing lower revenue to a tighter fleet and current macroeconomic conditions. Still, executives say turnaround efforts are working. The shares, though, down over 18%. And Lou, we were talking before this about Bill Ackman and his continued love for the stock, or maybe spiteful love. Yeah. It's a relationship he can't get out of. So what do you think Ackman is thinking on this stock?
It's a toxic death spiral. I just don't understand what attracts him to a business. Automobiles, airplanes, and groceries have terrible operating margins. When you've got tens of billions of dollars to invest, why are you going after things that don't have much margin to improve upon? So I think Hertz is really still struggling post-COVID. They seem to be in this relationship rut, if you want to call it, where they keep going back to trimming down their fleet and then building it back up. And everyone gets excited because you're seeing better economics after they trim. But look, this is a business that I think we talked about it is overpriced. Their rental rates, if you travel a lot, they're not the most competitive, and their operations are not very seamless or smooth. So I don't know what he's betting on, but he's got a lot more money to lose and make in other places where he can afford to do it.
Yeah, you don't want to be betting on a company that has high-priced services when we're in a macroeconomic question mark environment right now. But let's look at On Holding, lifting its full-year outlook for sales driven by strong demand. The Swiss shoemaker's first quarter sales also topping expectations, up 40% from a year earlier. The share's up nearly 9% at the moment, and we've spoken with the CEO previously on this program, and CEOs have talked about the fact that the company is really in a strong place when it comes to any headwinds from tariffs. We know footwear is one of the areas that has been subject to some headwinds from tariffs, but clearly this quarter able to eke out some gains.
I mean, look, you got to applaud the growth. I think they're benefiting from the halo effect too. You can see On sneakers everywhere. I was in Paris and Amsterdam in the last month, all over the US, it's there, but now they're getting that halo effect from apparel. You're starting to broaden out into that, which has better margins. I think this is a growth stock that's got more momentum, and this report shows it. So,
are you buying at these levels?
I don't know. I'm not really. Retailers is not usually on my list, but no, it's interesting. It's worth following right now for me as a potential momentum play.
Stock to watch.
The thing that's surprising, this is a good read through for Birkenstock on Thursday, right? Which I can't believe Birkenstocks or Crocs are still a thing. But everything comes full circle, so the retail shoe trend is definitely on point.
Yeah, it's really interesting to watch. Thank you so much, Lou. Great insights as always. And you can scan the QR code on your screen to track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. We're going to have all your markets action ahead, so stick around for more. You're watching Catalysts. Do a quick check here on the major averages. Your S&P 500 up 0.7%. Your tech-heavy NASDAQ taking the majority of the gains, up nearly 1.3%. But let's double-click on the S&P 500. I want to pull up a year-to-date chart because the S&P 500 is officially up on the year if it were to close at these current levels. The level that we are watching this morning is 58.81. That is the level that the S&P 500 has to close above to officially be up for the year. Right now, it's at about 58.88. So we are on track to close up if we do continue these gains to the upside on the S&P 500. And as a reminder, that is a far cry from the 15% drop year to date that the S&P 500 was sitting at on April 8th after a slew of tariff-driven headwinds and headlines led to a lot of market pessimism coming in here. But now we are seeing that movement coming in back to the upside as stocks have recovered from those losses, at least at the current moment. Well, Treasury Secretary Scott Bessent was optimistic on Tuesday when discussing talks with Asian trading partners, telling reporters things are going well on the heels of a temporary truce with China. Bessent was more cautious on EU negotiations, saying talks between the U.S. and Europe may be a bit slower thanks to differing attitudes within the bloc. Comments come just one day after a China tariff pause ignited a monster rally in U.S. markets. So what might future negotiations mean for the U.S. economy? John Lear, Morning Consult Chief Economist, joining us now. John, great to speak with you this morning. I want to talk about the data that you have for us on consumer sentiment. If we can pull up the chart on that here, you'll take a look at this because you say that we are already seeing an increase to the upside in consumer sentiment off the back of negotiations, not deals. Talk me through that, because I have a hard time believing that consumers are following the tariff headlines the same way that you and I are because we're paid to. How is sentiment already recovering off the back of this news?
Well, I think there's two primary channels through which sentiment is recovering. The first is that sort of direct policy channel, right? Just some level of tariff easing. Even before the trade negotiations with China were announced, we already knew that the reciprocal tariffs were being walked back slowly but surely. So there was sort of momentum in that direction. And then the other more, I think, direct effect on consumers is through markets and public markets. So strong stock markets lead to a strong wealth effect. And we see that, in fact, when you take that number and break it out by different market segments, we see higher earners with more money invested in the stock market have more directly benefited from these trade announcements over the last couple of days.
Yes, talk to me about that. The idea that the wealthier consumer is feeling better because of market activity here, how does that impact what we would call the hard data, the actual spending patterns for that higher income group, which does make up the majority of consumer spending?
Yeah, it impacts it pretty directly, although I would say it impacts it, the word I use is asymmetrically. So we know that a rapid deterioration in sentiment tends to lead to a deterioration in spending. We see that, for example, the Chicago Fed uses our data for their nowcast of retail sales, their CARTS index, really for that real-time downturn monitoring effect. And so I think right now we're in a situation, right, where we've got sentiment recovering. We continue to see a strong labor market. Through yesterday, the data I saw showed that we had another strong week last week. And so I think all of that together paints a picture of a really strong consumer. Remember, not too long ago, pre-Liberation Day, the U.S. economy was in a great position. I think slowly but surely we're trying to get back essentially to where we were at the end of March.
And my guest host, Lou, has a question for you, John.
Hey, John, it's amazing what a difference a week makes in terms of trade talks and negotiations. It looks really constructive. But my question for you is, how do we factor in the chance that these trade talks could fall apart just as quickly as they came together? And at what point does the consumer just get fatigued and change their behavior permanently because of that? They don't know when it's going to happen. I mean, how do you calculate for that? I mean,
it's a great question. I think thus far what we've seen from consumers is some reticence to dramatically change their behaviors in response to trade negotiations, tariff negotiations, right? Because announcing a 145% tariff on Chinese-made goods is not the same as, in fact, paying 145% more the next day. Companies have ways of working around things. We also know from our small business survey that we run with the Boston Fed that small businesses were very reluctant to immediately pass on those elevated costs. They were going to do so over a period of 2+ years. So I think from the perspective of consumers, they're sitting back and they're saying, well, what does this mean for me and my pocketbook? The expectations of tariffs, I think wrongfully were over, I think people wrongfully thought tariff announcements and tariff expectations were immediately going to affect consumers' pocketbooks. That didn't happen. And so we've got some breathing room right now. And I expect consumers to go back and spend.
Yeah, so just to follow up too, in terms of the hard data versus soft data, right? If we don't know where consumers are going to lay out, how do you balance that? Ignore some of the sentiment data, and what data, hard data, would you put more priority on given this environment?
So I think right now in a period of elevated volatility, I tend to look more at the soft data just because it's more of a real-time indicator. On top of that, with the hard data, you're going to get revisions, 3 months, 6 months, 9 months down the road. So you've got to be a little careful as it relates to sort of where you prioritize the signal as opposed to the noise. We saw very clearly in the announcement following the Liberation Day that consumers were starting to feel worse about their expectations, but their assessment of their personal finances remained pretty strong. That's what I was telling a lot of CFOs and heads of investor relations was, look, the future is really uncertain, but the present is pretty strong. And so there's an opportunity right now, to sort of adopt this, to go try to capture some of that market at the higher end of the income spectrum in particular, where folks have a little bit more room to absorb higher costs. So I think it's going to be a really sort of company by company specific outcome as it relates to the consumer. But overall, we're in a much better position now than we were a week ago.
Well, talk to me about the labor market here, because one thing that I want to hit on, we're getting some headlines that Microsoft is cutting 3% of all workers. They are not tying this to any performance-related issues. A spokesperson telling CNBC one objective here is to reduce layers of management. John, I wonder how you're thinking about how companies are responding to the macroeconomic uncertainty of this moment. I heard you saying this idea that consumers were going to have this stark negative reaction straight away was a little bit overdone. Fine, but we're already getting headlines that companies are cutting their staff. So does that economic impact start to trickle in and slow the economy?
It might. The strength thus far over the last few weeks of the U.S. economy has been the jobs market. And I think there is certainly a world out there. You could imagine a world where tariff announcements created such uncertainty that businesses immediately pulled back on hiring and started laying workers off. We didn't see that. We didn't see it in Morning Consult's own proprietary data. You didn't see it in the jobs data for April. You don't see it in the unemployment claims data. I think that's because companies deep down inside know that there's money to be made by selling in the here and now, in the present, and that it would be a significant loss of opportunity to go sort of shut things down, essentially because you expect the future to be so uncertain. Instead, what's more likely to have happened, and what we see in some of our small business data, is that businesses reduce their longer-term investment planning. They reduce some of their more speculative investments, but they continue to hire and staff in the near term, again, because there was money to be made. So it's sort of like a game of musical chairs. Nobody wants to be left without a chair, but you don't also want to be the first one to sit down unnecessarily when there's still a game to be played. Yeah, cyclically, we are coming off that labor shortage coming out of the pandemic, so certainly coming into play here. John, really appreciate your insights. Thank you. My pleasure. Let's check in on shares of Microsoft, down just a touch. The company said it's laying off 3% of employees across all levels and geographies, according to CNBC. It's likely Microsoft's largest round of layoffs since the elimination of 10,000 roles in 2023. Back in January, the company announced a smaller round of layoffs that were performance-based. These new job cuts, the company says, are not related to performance. Microsoft had 228,000 employees worldwide at the end of June, meaning that the move will affect thousands of employees. One objective is to reduce layers of management, according to the spokesperson. The company reporting better than expected results and an upbeat quarterly forecast back in late April. Again, those shares under just a bit of pressure this morning. Well, big tech, much more ahead on Yahoo Finance. Big tech stocks leading market gains today, with the Nasdaq 100 officially wiping out year-to-date losses. The Magnificent Seven adding more than $800 billion in market value following the deal between the U.S. and China to temporarily reduce tariffs. Joining us now with more, Dan Ives, Wedbush Securities Global Head of Technology Research. Dan, great to have you as always. I know you say this truce is the best case scenario. Which tech stock is the biggest winner within that scenario?
I think it's Apple and NVIDIA. I mean, if you look at this, that was the black cloud, right? I mean, the supply chain hearts and lungs are in China. And as much as you could talk about moving to India and others, this is a huge sigh of relief. And I think it changes our view that, new highs for tech, new highs for the market, now on the table after what we just view as a dream scenario happened this weekend.
Well, Dan, let's talk about Apple a little bit. I know you had a call for a $3,500 iPhone if production was brought back to the United States. What's your call on the price of an iPhone today?
And look, it comes down to I mean, they're going to have to struggle not to raise prices if you actually, they don't get exemptions and you actually keep some sort of tariff in when it comes to China. Look, it all comes down to the reality is iPhones need to be made in China. Some can be made in India. They can never really be made in the US. Because if you want them made in the US, the price points would basically be massive demand destruction on day one. And it would take 4 to 5 years to even build 10% of that in the US. So that's why our whole point over the last, call it 6 weeks, was let's talk reality versus fairy tale. And the reality is that iPhones will continue to be built in China, with some being built in India.
How do you suss out the reality versus a negotiation, a framework, a thinking of a deal when there isn't necessarily clarity yet on the goal of these tariffs?
Look, I think ultimately they're both playing poker, and especially U.S., they look at their hand, it's not a good hand, right? And I think they had to move further and further back from the cliff in terms of what we saw with the delay of the reciprocal, and obviously when it came to China, because the cargo data doesn't lie and the price points doesn't lie. And whatever CEOs are saying publicly behind closed doors, what they're telling the White House is you need to change, you need to move. So our view is, like, even when it comes to the 30%, I mean, that's probably the high bar. It goes to what, call it a reciprocal 15%, 20%. Once you work out WTO, IP, and all the other issues are going to have to get worked out over the next year. But you don't want a decoupling when it comes to AI revolution. And I think this was, a potential black swan moment that was self-created, that's no longer there.
And Dan, my guest host, Lou Basenese, has a question for you.
So Dan, I just want to talk to you more about Apple. I feel like early in the show I said this time of year everyone gets a bit negative on Apple. How worried are you about price sensitivity, right? I mean, the consumer is super loyal to Apple, 2.5 billion devices out there. You got a lot of subsidies. Does it really matter if the iPhone price is a little bit higher than it was expected? I mean, do you really think that impacts demand?
Yeah, no, it's a great question. Look, I mean, the last thing Apple wants to do is raise prices. And they've kept prices basically the same. The reason that is because you have, call it 300 million iPhones that haven't upgraded in 4 years. So even if it's 3%, 4%, 5% of that may be delay for a year because of a $100 increase or $150. That's not what Apple wants, but they're beholden to their supply chain. But when it comes to going into WWDC and iPhone 17 and obviously AI, I mean, this is a key period for them to actually see growth in terms of high single-digit, double-digit growth, which is obviously evaded, in terms of the Apple story over the last few years.
Dan, one quick follow-up. Earlier in the show, I said the Mag 7 was a boy band like IXIC that's breaking up. Who would be? And
I love IXIC.
Yeah, look, who would be your Justin Timberlake though for breakout? You said Apple and Nvidia. If you had to pick one for the best breakout for investors right now, which one are you most optimistic about on the aftermath of these trade truce?
If there was like a Timberlake part of IXIC breaking out, it would have to be Nvidia. I mean, and look, Jensen, we'll see what happens with the black leather jacket if he had to, make it to be a boy band. But look, I think the reality is that I think it makes all new all-time highs because there's only one ship in the world fueling the AI revolution, and that's led by Godfather of AI, Jensen NVIDIA.
How big of a catalyst, Dan, is the fact that the United States is lifting some of these sanctions between the U.S. and Saudi Arabia when it comes to chip purchases? We're seeing the shares of NVIDIA up over 5%.
It shows it's not just about China. I mean, think about it. That was not on the table when you look at that whole market. It's not coincidental that they're in Saudi Arabia this week after, obviously, the U.S.-China, weekend talks with Basenese, because it shows, like, when you think about AI revolution, you only have 4% of U.S. enterprises going through AI, 0% in Europe, 0% in Asia outside China, and in Middle East, it's baby steps in terms of where we are today. So this just shows what I believe is going to be happening over the coming years. The trillions being spent on AI. And obviously it starts with chips, but think about on the software side, from Microsoft to Google to Amazon to obviously names like Palantir, which I kind of view as front and center the best pure play AI name out there.
Dan, let's talk about Microsoft since you mentioned it. A report from CNBC citing a spokesperson with the company that Microsoft is cutting 3% of its workforce. Any take on that?
I mean, I think they're just doing what they do every kind of few years. They're still hiring when it comes to direct sales. I think some of the strategic areas. But look, companies, and we've seen with a lot of big tech companies, they're going to have to continue to focus on strategic versus non-strategic. But right now, it's Microsoft's world, everyone else paying rent when it comes to what we're seeing on core cloud in terms of enterprises. So this is in no way any sort of sign of weakening. I mean, they just had a quarter. That was just a Saquon quarter they posted.
And I also, before we let you go, Dan, want to get your take on Tesla. We saw the share slumping a bit off the back of a fall in Chinese sales, but of course, back up today, perhaps off the back of images of Elon Musk and President Trump together in Riyadh, and also the broader market lifting. What's your take on Tesla?
But also remember, like, Musk is in Riyadh as CEO of Tesla, no longer in terms of my view with Doge, Trump administration. Remember, that dark chapter is over. Now it's about autonomous when it comes to Austin in June. I believe it's the next stage of this massive story for Tesla. And I think, look, they're going into a Jalen Brunson moment. I think it's just the start of what I see as just massive growth. And I think a $2 trillion market cap could potentially now be on the table for Tesla.
Really great overview, as always, Dan. It's always a pleasure to have you. Thank you so much for making the time, and thanks to Lou for joining the conversation as well. Perplexity is in talks for a new round of funding that would value the AI startup at $14 billion, according to reporting from the Wall Street Journal. That represents a more than 50% increase from its valuation late last year. The new funding round, which is expected to total $500 million, is a sign of still present enthusiasm for AI companies, some of which are leveraging the new technology to challenge Google's longtime dominance over web search. Perplexity is one such company. Its search tool provider provides users with summarized answers that include links to sites. Perplexity also plans to launch its own web browser, Comet, in a potential challenge to Google Chrome and to Apple's Safari. Last November, Perplexity was valued at $9 billion. It's among the startups riding the wave of AI enthusiasm initiated by ChatGPT just 3 years ago. And as I mentioned this, I want to let you know that you can find the Yahoo Finance platform to track more private company data, including valuations and funding rounds, by scanning the QR code here on your screen. And that's what that private company data will look like for you on our site. We're going to have all your markets action ahead, so stick around for more. You're watching Catalysts. The S&P 500 currently on track to wipe out losses for the year. We are now higher for 2025. But what do the market technicals signal about the health of this rebound? Joining us now, we've got Jeff Buchbinder, LPL Financial's chief equity strategist. Jeff, a great time to talk to a technicals person. I really appreciate you being on with us here because I want to know what everyone wants to know. Is this year-to-date now gain on the stock market going to hold?
Yeah, well, thanks for having me on, first of all. I do fundamentals and technicals, so I'll get that out there first. There are some very positive technical signs here. For one, that massive move yesterday, certainly, we saw about 90% of stocks above their 20-day averages on the S&P 500, very positive technical signal. And of course, which everybody's talking about, we are above the 200-day on the S&P 500. So generally speaking, that's a positive signal, especially if you're coming off of a big downdraft. Perhaps the most positive piece of this is that it's going to drag the technically driven trend followers back into the market. There's some big institutional money that's coming back in. We've already seen reports of those dollars moving in. That can actually allow these gains to hold.
Jeff, of course, your expertise knows no bounds. You can talk fundamentals, you can talk technicals, but I'm interested in the technicals at the moment because of exactly what you said here. And one thing I'm curious about is at what point do we start to see selling get triggered if the rally is apparently overdone to some investors? What might that look like?
Sure. Well, we've been looking at this 5,800 level as key technical resistance. There are a lot of reasons for that: previous highs, previous lows, as well as near the 200-day moving average. Markets are pricing in a lot of optimism right now. In fact, we at LPL have been telling our clients we've gone from peak tariffs and max uncertainty to clarity and trough tariffs. So think about that. In a very short period of time, essentially we're pricing in the best case scenario. we're on top of the wall in terms of the wall of worry that stock markets climb. And so in the very short term, we do think we need to pull back a little bit, digest these gains, and perhaps see the market be a little bit less complacent and start pricing in the risks. We've got still sticky inflation, although the CPI news was positive. We have potentially a little bit of an up move in rates, which of course can drag on stock valuations. And then these tariffs, if 10% holds, that's certainly good news overall. But if we see those tariff rates creep up to maybe 15% overall, that's not so positive. Market's pricing in a lot of good news right now.
And Jeff, my guest host, Lou, has a question for you.
Jeff, I'm a fundamentals first guy and mostly, but I do pay attention to technicals. And I'm just curious, I'm not sure if you're one of them. About a month ago, everyone was freaking out over the S&P 500 death cross, which fast forward to today and really wasn't that deadly. How do you decide what technical indicators are the most important for investors to follow? From your vantage point, what are the strongest technical indicators to follow?
To that, I would say breadth. Right. And so I cited one stat in terms of the percentage of stocks above the 20-day. We also like to compare the moves to prior historical moves. And so this move actually resembles some of the really big reversals in the past. You can look at 1987. You can look at 1998. You can look at 2011. Right. Probably have to take out some of these bad recessions, not very comparable. We don't think we're going to have a recession this time. But some of those big moves certainly resolved higher. Now, retests happen more often than not. Now, the retest doesn't have to go all the way back to the lows, but you see throughout history, better chance than 50-50 that we retrace a big portion of this up move. Hopefully this time the economic data and the earnings is supportive enough that we don't have to retrace even half of this move. But 17% move in about a month is a pretty big move that probably needs to be digested.
And Jeff, you talk a little bit about the idea that earnings estimates have come in just a bit because of all the macro headwinds and the uncertainty out there. What does that signal for where stocks can head going forward? Is it a good thing that those estimates have started to come in?
Yeah, that's one of the things we were looking for to signal a durable low, which now we think is probably in. Credible estimates are probably finally here, right? Somewhere in the 257 to 258 range is generally where the strategists are landing here. Now that we got the good news on China tariffs, potentially a little higher than that is in play. So, we have a bull case scenario of about 6,100, maybe a little higher than that. The odds of that certainly have gone up now that estimates have come down to a level that's credible, and the market can start pricing in some of the benefits of the tax cuts that are coming. Remember, this market's had to essentially take its medicine. We've been saying eat vegetables of tariffs before the dessert, before the sweets come, which is deregulation and tax cuts. We're now moving into that dessert phase, and the sooner that stocks can start focusing on that, certainly the better.
Yeah, and certainly questions about what that dessert phase is going to look like in reality. Jeff, really appreciate you joining us, Jeff Buchbinder. Thank you so much.
Thanks a lot.
And we're going to get final thoughts with Lou Basenese, who's been with me for the hour. Really appreciate it, Lou. I want to get a take from you on the extent to which you see this rally lasting.
So I think it has legs. There's a big disclaimer in here, and I'm going to say why it has legs and then go to the disclaimer. I think it has legs because Jeff was talking about it too. Earnings are very strong, right? Analysts were expecting Q1 growth of 6%. We actually right now are tracking for 12%. Later half of the year, we still have double-digit growth expectations. That's ultimately what drives stock prices. The disclaimer is, if this on-again, off-again trade war goes on again, then all bets are off because you're really going to get a system and companies that are fatigued, and you're going to start seeing these increases in price work their way into the system. Everyone's going to get tired of a 90-day pause every time there's it gets too painful. So I think that's the real threat. I don't have any confidence in anything, in terms of a deal until it's done. I've done investment banking for decades. Deals fall apart a million times before they actually get done. So we're on a good path, but I'll believe it when it's inked.
I think that is very important context for our audience, straight from the source. Lou, thank you so much for joining us for the hour. Great insights, as always. Really appreciate it. Coming up here on Yahoo Finance, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith, he's going to have you for the next hour, so stick around here for more.